So today we'll be looking at financial proposal for capital, for expenditure provided by others. So we'll be looking, the main aim of today's session is for you guys to be able to evaluate financial proposals for expenditure provided by other people, not expenditure by yourself. Any expenditure provided by your colleagues or your boss, your manager, your CEO, or consultant, or any other person. So at the end of this lesson, students should be able to identify criteria by which proposal can be judged. Like, you should be able to know, why is this? Why do I need to accept this proposal? Why do I need to reject this proposal? Why is this proposal not viable? Why is this proposal viable? You should be able to critically analyze the viability of a proposal for expenditure. If you're given a task on what do you think about this, for example, this project in next 5 years time or in next 8 years time, you should be able to come to conclusion that this project in next 5 years time, I think this is going to happen, or in next 4 years time, I think this is going to happen. Also, you should be able to identify the strength and weakness of a proposal and give feedback on the financial proposal. So towards the end of this session, you guys should be able to identify why this proposal is wrong. What do you think? And you should be able to come up with the strength and the weakness of each of the proposals, like each of the techniques we're going to use. And you should be able to analyze the viability of a proposal for expenditure. So let me just say this, just an introduction. Once a cash flow statement for a proposal in a form of suitability is form of suitable for the calculation of profitability has been prepared, proposal evaluation method, which are in very common use, can be applied to compare different proposals or evaluate a single proposal. What I'm trying to say is, in each of the projects, in each of the proposal, they've got different kind of techniques, different kind of ways to calculate the viability or the profitability, calculation of profitability, and to calculate how suitable that proposal is. Because there are some proposal, if you calculate the proposal, you find out at the end of the year, you'll not be able to make profit. At the end of the year, you might not be able to meet some of your obligations. So in order to get a good idea on that, you need to use some tools like the Payback Period, some tools like the NPV, which is the net present value, some tools like the IRR, internal rate of return, some like the ARR, the accounting rate of return. So what I used to tell my students, most of this stuff, like the ARR, NPV, IRR, the PBP, have their own advantage and disadvantage. Each of them have their own formula and ways of calculating it. Each of them have what you need to do to accept such kind of project, what you need to do to reject those kind of projects. So it's not all about using the formula. It's about knowing, okay, I've done the calculation. Should I accept it? Is it worthwhile? Or is it not worthwhile? Should we reject the project? Things like that. So let's look at capital budgeting and investment decision. These are decisions about when and how much to spend on capital assets. Capital budgeting is the process of making such decision by identifying alternative, evaluate and rank choice, and make decision. There's what we call profitability index. For most of you guys that are into finance and accounting, you should know more about profitability index. Now you use the ranking. When you evaluate the project, you need to rank it. Which one has first, which one has second, which one has third. So you rank them and you comment on them. But because of the cost of this, finance for manager will not be able to do that. Also, measures used in capital budgeting. Like I said, there are different kind of tools like the net cash inflow, which include the increases in cash receipts, less the cash payment made on a project. So it's very simple, the net cash flow calculation. It's just for you to carry your increase in your cash receipt, you less it with the cash payment made on the project. And it can be a series of equal or unequal amounts. So it must not be it must be equal. It must be either equal, unequal amount, negative, or a positive amount. Also, cost savings are measured as the reduction of the cost under each alternative. Do you guys have any questions to ask before I move to the next slide, please? There's a chat. Okay. Amani said no, clear. Okay, so we'll continue. Well, today we'll finish on time, and there's a question again. Shira, no, good for now. Okay. Okay, let's continue. So, other consideration when calculating or accepting or rejecting a project, what you need to look is income taxes will affect cash flow and must be considered. So your income taxes, it must be considered because it's going to affect your cash flow. Definitely you need to pay your tax, things like that. Depreciation expenses does reduce income. So your depreciation expenses will definitely reduce your income and your income taxes, but it does not decrease cash flow. How will I explain this for you guys? You know, like your cash flow, you've got inflow and outflow of cash. So inflow would be your income. Outflow would be what? Your expenditures. So like depreciation expenses is part of your expenditure. Income taxes is part of your expenditure. So this will not affect your cash flow, but it will reduce the income. Because if you have income, you less your expenditure from your income. That's where you get your balance, which might be maybe your profit or your deficit, which might be your loss, or things like that. So sales of the old asset will provide additional cash received upfront. Sales of the new asset at the end of their useful life is an additional cash flow at the end of the project life. So like what it's trying to say is like sales of old asset, like if you sell your old asset, definitely that's a receipt, that's like an income for you, you know. So you could get additional cash upfront, and sales of your new asset at the end of their useful life is an additional cash flow at the end of the project life. I hope this makes sense. I hope this makes sense. Should I proceed? Or you guys have any questions to ask? I think I'll just proceed. Okay, I think there's a message. 2 messages. Yes, you can proceed. Yes, it is clear. Okay. So the next one is what? Payback period. So the payback period, the payback is a measure of how long it will take to recover the initial investment. Is the period is going to take to recover your initial investment. For example, you're investing 50 million pounds for a project. So the period is going to take you to recover that 50 million pounds. That's what they call payback period. Does that make sense? Okay.
Yes, we are with you.
Okay, thank you. When you have equal cash flow, like the same cash flow, your payback period will be initial costs divided by annual net cash inflow. That's when you have equal cash flow. And in these techniques, what you need to know is that if the payback is lower than the life of the project, then you accept the project or proposal. Take note, if the payback is less than the life of a project, the life of a project it might be, for example, 10 years, 20 years. Excuse me. Oh my God. Okay. If the payback, if the project is for 10 or 20 years, and the payback period, when you calculate it using your initial cost divided by annual cash. Oh God. By annual net cash inflow. If you divide it, you find out that the cash, the payback period might be maybe 10, might be less than 10, maybe like 8 or 7 years or 6 years. At that point in time, you need to accept it because you don't need to wait for that 20 years or that 10 years. So it's even less than. So you just need to accept the project. Is what why you get your money before the due date, which is better. There is nobody that want to stay long in doing business. The main thing, to get your profit as soon as possible, move on. So does that make sense? Before we go into some calculation.
Yes.
Okay. Thank you. I think there's a chat here. Yes. Okay, Shira. Okay. So the payback period, this is an assumption. Just see, for example, the cash payback method. You have investment cost of what? $200,000. You have expected useful life of what? 8 years. You have expected annual net cash flow of what? Of $40,000. So using the formula, like I stated earlier on, your total investment divided by all your initial investment, you could either call it initial or total investment, divided by your annual net cash inflow. So in doing this, our investment cost is what? Is 200,000. Our expected annual cash flow is what? Is 40,000. So you take 200, if you're looking for the cash payback period, you take your 200,000 divided by 40,000. That will give you what? I want you guys to do that calculation for me. 200 divided by 40,000. 200,000 divided by 40,000. Okay, I think I've got an answer here. 5 years.
5 years, yeah.
That's correct. So that's 5 years. So with what I explained earlier on, what do you guys think? 5 years compared to the 8 years. What do you think we should do in this project? Let me go to the next slide to check if that 5 years is
accept.
Okay, 200 divided by yes is 5 years. So we'll accept it because the 5 years is shorter or is less than the 8 years, because the 8 years, okay, payback shorter period, yes. The 8 years, it's going to take us 8 years to get the money, but if we use this, 5 years is shorter, so it's better I'll just go with the 5 years. We'll go with the proposal or the project. So the payback with unequal cash flow. This one is simple, but it's a little bit, will I say, a little bit tricky. So the payback with unequal cash flow, what you need to do is, when cash flow are not the same every year, you cannot apply the previous formula. If the cash flow is not the same like every year you got the same amount, you can't use the previous formula I showed you. You use this formula. Rather, you must determine at what point the cumulative cash flow become positive, where cumulative cash flow, which is the CF, is equal to initial investment plus CF, which is the cash flow, year one, plus cash flow of year 2. So you do it that way. It's simple. I'll show you how to do it. So over here, you see the cash payback method. This is an assumption. Assuming you have a net cash flow, you could see for year 1, year 2, year 3, you got different figures. They are not equal. Your cumulative cash flow, what you see there is 60 plus 40 will give 60 plus 80 will give you 140. 140 plus 105, or you add 1, 2, 3 together, you put it for your year 3. 245,000. You add 1, 2, 3, 4, or you add 2,000 year 3 plus year 4 to get your total year 4. Or you add 1, 2, 3, 4, 5 to get your year 5, or this 100 for the year 5 plus your 400 will give you your 500. Year 6, you go with the whole year, or you go with year 6 plus your 500 will give you 590,000. If the proposed investment is 400, let's say for example, if the proposed investment is 400,000, what is the payback period? So what do you guys think is the payback period?
Year 4.
Year 4. Yes. You are correct. Let me see what these guys have. I'm on year 4. Yes, you're right. Year 4, because that's where the 400 is. So let's continue. Do you guys have any questions to ask?
I think I have a question. Is there like sort of a set standard for the years? Because for the cumulative method, it's easy to know exactly when to have a payback period. For example, here, if you add, but for the previous one, you said the project useful life. So, and useful life was 8 years, but the payback period was 5 years. So is there like a set standard for the payback period whereby you say anything above 5 years you reject, or it depends on industry that the project is in?
Well, if I'm right, what you say from the question you just asked, is like, maybe you didn't get me clearly when I was explaining the other method. Let me go back so you understand what I'm trying to say. You see, like, there are two methods. We've got the one when, like, if you look at what is written here, it said when you have equal cash flow, then you use this formula. There are two things it says. You use the payback period, initial cost divided by these. And this criteria to reject or accept the project, it falls for both the two methods. It's not only for only this method, like for when you have equal cash or when you don't have equal cash. Like this other method, it has useful life. There is no yearly, the amount there is fixed, like a fixed amount. Well, if you look this other project, this other one, it has many years, and also the amount are not fixed. The net cash flow are not fixed. They are different amounts. They are unequal. If you see, like in year 3, you have 105. In year 5, in year 6, you have 90,000. So it's not fixed. So in this scenario too, looking at it, it takes 6 years. Looking at the cash flow, the net cash flow, year 1 to year 6, your proposal, the proposed investment is for 400,000. So if it's for 400,000, at year 4, that's when you get your payback period. So at year 4, since year 4 is lesser than the year 6, you understand? So at this one, you still accept the project. Amani, does that make sense?
Yeah, that makes sense. It's just like I needed to understand if there's a set standard for example, what if this cumulative formula will take, for example, 15 years? You know, is there like a cutoff year whereby you reject the proposal, whether there's a constant cash flow yearly or this cumulative method? I just needed to understand if there's a cutoff period where if it takes maybe more than 15 years to not to accept either way. But for this method, I've understood that.
Okay. I'm glad you understood that. So it doesn't have a fixed time you must accept. No, once you're using it and you find out that, oh, it's just like how will I put it? You buy a property. You bought a property worth £10,000, and when you bought the property, they told you it's going to take you 3 years before you recover your £10,000. And luckily for you, you have people that want to use your property. The first year, I'm just using this method for you. The first year, you got somebody that said he will pay the annual rent instead of monthly rent. You to pay upfront annual rent of, for example, £3,000. You collect the amount. The next year, you increase the rent. You saw someone that said he's going to pay £5,000 because the place is very close to social amenities like banks, is very close to supermarket, is very close to the bus station, is close to gym. You've got gym there, you've got recreation center. That this place is what is looking for, is ready to pay £5,000. And they told you within 3 years. They told you 3 years you get your money. And another person comes now, said, no, I'm ready to pay you £7,000 because it's just a walk distance to my place of work. I live very far. I don't need to pay for bus or take the train. And somebody offer to pay £7,000. Remember, the first year you rent it for £3,000, and somebody offer £7,000. 7 plus 3 is £10,000. So that £10,000 is at the second year, not the third year you're expecting to get your cash back. So at the second year, you've already gotten the money you invested, your initial cost, which is £10,000. So you don't need to continue the business again now. You just go and reinvest in another business. You look that, yes, this business is worthwhile. I'm just giving a scenario. So it's just same thing like this. Maybe, for example, this person is renting the property, and the first year he got somebody that paid £6,000. The second year, he got somebody that paid £8,000. The third year, he got someone that paid 105. The fourth year, he got 155. So it depends on what you get every year. And if you find out that your initial investment was for $400,000, at the end of it, you are able to get the $400,000 in 4 years. You accept the project. You don't need to wait till the 6th year to when you get the proceed of the project. So does that make sense, guys? Amani, I hope you now understood what I've been saying for quite a while now.
Yeah, thank you. I'm clear now. Thank you.
Okay. So let's continue. Let's ride on. So looking at this other assumption, they said if the proposed investment is $450, what is the payback period? So what do you think will be the payback period for this? So guys, what do you think? Looking at this assumption, what do you think? Oh, there's a chat here. 5 years or 4.5 years. Amani says 5 years or 4.5 years. So is there any
Year 5.
year 5? Is that what you think?
Yeah, £450,000 will not be paid in year 4, but in year 5, although it will be early in year 5. So I would go for year 5.
I'm sorry. Oh my God. So, well, you've been able to explain very well. I think the year will be 4.5 years because it will be in between year 4 and year 5. So it will be 4.5 years. So maybe you might get the money before the 5th year. So if you get it before the 5th year, so what do you think we should do? Should we reject this project or accept it? What do you guys think will be the best option? Amani said, accept. Okay, you're right, because it's less. We need to accept because it's less than the expected lifespan, which is 6 years. Do we all agree? Before I move to the next slide. Well, since there's okay, I think there's a chat here. Yes, so I'll move to the next slide. So the next slide says what? Using payback period. Payback is the easiest of the method to use, and it gives us a quick idea of whatever or not to be considered the investment option rather. So it's one of the simplest and the easiest to work on compared to IRR, ARR, and the rest, because some of them are a little bit confusing, but if you understand this method, it's easy to use. Also, it has its own weakness as it has its own advantage, which is one of the easiest and simplest method to use. It gives you a quick idea of whatever you want to do. So for this one, the weakness, it does not consider the timing of the cash flow, relatively amount over the years. And also it ignores any cash flow received after the point where cash is fully recovered. Do we all agree with this weakness? I'll tell you another weakness. You see this method, it doesn't give you the exact timing. Like when I mean exact timing, like you see the other calculation we did, this calculation is showing us 450. So it doesn't give you exact, like for example, it's meant to be like 4.5 years, but it doesn't give you exact. It's just for you to know that, oh, it should be in between this one. And looking at the amount, it continue. It doesn't tell you, oh, you need to stop at so yeah, so it continue like that. So does that make sense, guys?
Yes, it makes sense. But also, in taking this for an appraisal of a project, would you consider other decisions, whether to buy or to rent or to lease, for instance, and also the cost of capital in terms of buying the project or the equipment outright?
Well, you consider all those things because your cost of capital might be your initial cost, depending on how they put they call it. Your cost of capital could be your initial cost.
Mm.
You understand? So like it considers all those things. So just like I made example using rent, for example, you're buying a property and you're putting it on rent. Mind you, some property you need to repair the property, like do some paint, do some decoration, change the keys, do a lot of things. You need to work on a place before putting it on rent. You understand?
Mm-hmm.
So all those costs is part of your initial cost. It's part of your cost of capital. So when you now carry that cost, even including administrative fees, all those things, when you want to calculate the payback period, you consider all those amounts. Okay, I paid some guys to fix the doors. I paid some guys to change the kitchen, flooring, the bathroom, the brownie bathroom, things like that. So when calculating it, you consider all those stuff as your initial cost. And at the end of it, you should be able to come up with a realistic figure. Okay, I'm renting it with this amount, excluding all these expenditure. What will I get if I continue this project? Like if you look, for example, let me show you one of these calculation. No, the second one, yeah, this is more better. Your proposed investment is what? 400,000. And in 4 years, you've got in your capital, which is how much did you put? You put in 400. 4 years, you continue investing now, because look at the 5th year, you're still getting money. If you leave the 400, you'll still be 500. The 6th year, you get 90,000, which is what? 590 in total. So a reasonable person, rather, even though the net cash flow is reducing, but you still have good amount of money. Because it started with $60,000. The second year, it increased. The third year, it increased. The fourth year, it increased. The 5th year, it reduced. The 6th year, it reduced. But looking at how much you've invested already, you still make profit, even if you leave it to the 6th year. But you get your capital before the lifespan of the expected lifespan. You understand? Just like this other one too. Where is this calculation? Okay, just like this one too. You invested 40,000. Investment cost $200,000, and you expected annual, like every month, every year, cash flow. You get 40,000 every year. You get 40,000 before 5 years, and the surveyor, how did they call these guys renting house? Your agent, the property agent, told you within 8 years you get your money back. And in 5 years, if you're getting 40,000, in 5 years, you get your money. If you continue, let's say you get your 200,000 in 5 years, then you've got 3 years before the expected lifespan, useful life. So 3, which is 40, 40, 40, that will be 120,000. So you get a balance of 120,000 profit before the expected useful lifespan. Before, you understand? So there is no how you're going to use the payback period. You actually know how much you will make. So it's simple, something you could even try in your little way. If you're doing your business or doing anything, you could just put a payback period. Okay, if I'm getting this from this business in next 5, 4, 5 or 6 years, I'll get this amount of money. So does that make sense? Is it Amani? Am I right? I don't know what I'm talking to.
It makes sense. Yeah.
Yes, sir. Okay. Okay. So let's continue. Or should we go for a 10 minutes break, then come back and continue? Should we go for a 10 minutes break and come back? We'll come back and continue this remaining slide. Or we should finish in time today.
I am of the opinion that we should just continue so that we can finish and then just get over with it, if that's okay.
Okay.
Everyone, okay.
Okay. The accounting rate of return. This is another method or another techniques you could use. So the ARR is another method of evaluating alternatives. It is easy to determine, but it also ignores the time value of money. You could see, now you could know the disadvantage of it. So the ARR, the average annual net income, is divided by the average investment cost, where the average investment cost is equals to initial cost plus residential value divided by what? So in this place, the ARR, when the ARR is greater than the cost of capital, then you accept it. You could see PBP is payback period is when the payback period is less than the expected lifespan. That's when you accept. Does that make sense, guys? Hello, guys. There's a chat here. Yes, Amani, thank you. Let's go. Let's do an example, Amani. I love these guys. Okay, let's continue. So let's look at the example. Average rate of return method. Let's is an assumption. For example, your machine cost is what, $500,000. Your expected useful life is what, 4 years. Your residual value is none. Your expected total income is what? Is 200,000. And remember, the formula is your expected average annual income divided by your average investment. So yeah, in calculating it, you just need to use your expected total income divided by the number of years, divided by 4. Then your machine cost plus you don't have your machine cost divided by 2. If you do this, first of all, this divided by 4 will give you 50,000. 500 divided by 2 will give you 250. So it will now be 250 divided by 250 will give times 100 will give you 20%. So your average rate of return will be 20%.
I'm quite lost where the average investment 500,000 plus 0, which I assume is the residual value. But why is it over 2? What is the 2 representing?
The 2 is representing average. So like if you're looking for average of something, what will you do? You divide it by 2. Shara said, yeah, 0 is the residual value. You're asking?
Yes, sir.
Okay, let's go back to the formula. So we'll look at it again. Looking at this formula, your average annual net income divided by average investment cost. So to get your average investment cost is your initial cost plus residual value. We don't have any residual value. We divide it, you put 0, then we divide by 2. So is it Amani? So are you okay with this formula again?
Yeah, I have understood that. I had missed. I had.
That's why I said no problem. Let's go back to the formula.
Yeah, got it.
Yeah. So your residual value, Shira, is 0. So if you add it, you divide by 2. So the 2 is there.
Okay, so in case if the residual value is different, given different in some example, so in that case, we'll have to put that as the residual value, like it can be anything else, right?
Yes, your residual value, for example, can be maybe 10,000, 20,000, 40,000, 50,000, you know. So you put it, you add it together. But if it's not there, they didn't give you, put 0.
Okay, thank you.
Okay. So if ARR is greater than the cost of capital, then you accept the project. So let's continue, guys. So looking at this, we'll get 20%. So what do you think is going to happen? Should we accept this project or reject?
looking at this, that means every year the project will return 20% of the cost of the project. So this would take 5 years to pay off the initial investment, which is 500,000. But the useful life of the machine or project, the machine is 4 years. So you'll be making a loss of a year.
Yeah.
If you were to go by this. Yeah.
Thank you very much. In fact, you just made my day, because looking at this, you'll be making, if you just go into this project, you really lose. When I mean lose, you lose 1 year worth of money. So it's better not to consider this project. Okay, so let's continue. The time value of money. The money received today has greater value than the money to be received in the future because of the effect of compounding interest. I will tell you some things. See, before COVID-19, money had good value. But when COVID-19 came into place, in some countries, especially developing countries, money does not have value per se. So look at everything, what? Look at just shaking that. I don't know what was that.
Exactly. It's like a tornado. Goodness.
I just have to remove him immediately because I can't. Well, as I'm saying, just by the way, it's one of those things you need to deal with in studies, in teaching people. So, like I'm talking about the time value of money, like in some developing countries, now inflation rate because of COVID, for example, like this Brexit now, there are some products that are not being produced in the UK. So it's difficult for people to get some of those products because of COVID and things like that. So the time value of money, a £1, the £1 you have in 1980 and £1 compared to 2021 is not the same £1. In 1980, maybe you could use the £1 to buy a lot of things. But now the £1 is not, maybe you could get maybe sweets or just a box of chocolate or something like that for £1. If you go to Poundland, not every shop you could use the £1 to buy things like that. So because of the effect of the compounding interest, PV is what we call the present value. The lump sum is equal to future value times the present value factor. The PV annuity, which is the present value, is equals to the payment times the present value annuity factor. That's the PVA. Where the present value, which is the PV factor, are a function of the interest rate. And at the same time, the annuity is a series of equal payments. I'll show you, okay, I don't know, maybe next one. As we're going on, I'll show you some discounted present value. So you just see it. Here we will just be using the table when we want to calculate. Then this annuity means the present value. You can add all the present value. For example, if you're doing for like 4 years, you can add all the present value, 1, 2, 3. You now put it in bulk, now calculate it at once, instead of using 1 year for 1 year, 1, 2 years for year 2, 3 years for year 3. When we get there, I'll show you how to use it. So the next net present value method. This method of evaluating capital project involve the calculation of present value of all net cash inflow less the cost of the initial investment. If NPV is greater than 0, then the project is acceptable. The method is the best in evaluating alternative. So like each of the method have their own, will I say, advantage and disadvantage. For this method is the best in evaluating alternative. So please take note, if the NPV is greater than 0, then you need to accept that project. But if it's lesser than 0, then you need to reject that method. So the net present value method. Looking at this net present value method, you see year 1 to year 8. You see the annual net cash flow, the present value for $1 factor, the present value for the cash flow. I'll show you how they got this net present value. Can all of you see? Uh-oh. Can all of you see this? Is it big enough?
Yes.
Okay, so we're looking at $1, which is 0.89, 0.89. I'm coming. 0.8, is it not 12 years? Yeah, 0.89. This is it here, the discounted table. So for the first year, we're using the 12%. The first year is 0.8929, 0.7972, 0.7118. So if you go here, you see it 0.78929. This is for 12%. 118. So for 12%, you bring all the figures for 12%, depending on the year where it stopped. Like this year, it stopped to 2000 year 8. For 12%, year 8. I think I'm right. Year 8. Year 8. 0.4039. 0.4039. So now you times your annual net cash flow, which is this times this, give you this. This times this, you give it this. This times this, you give it this. This times this, you give it this. You now total them. So the amount to be invested is £16,000. Sorry. So you let 16,000 minus your present value of the cash. You have what? 434,367. So looking at this, the net present value is more than zero. So in this case, you're definitely making a profit. So you definitely accept this project. Does that make sense?
That
Yes.
did I cut you short? You can go on.
What did you say? I didn't hear you.
No, I was just giving my colleague a chance to speak. I think he was the first one. Then
Okay.
Money, please.
Okay. So
it makes sense. The calculation makes sense, but I would like to understand, how do you arrive at 12%? I know you have the discounted table, but how do you arrive at 12%? Why not 11? Why not 9?
okay, they'll give you the percentage. So you just go and use it.
Okay.
When we start solving some questions, you see they'll give you.
Okay.
You not just go there and check. So looking at this one, they say present value factor for 12%. Like this one is given. Am I right?
Yes.
So using the 12%, you go to the table and you use it. So if you use it, 12%, you bring it and you put it there. And you times it. Even this amount invested, the amount to be invested, they will give you. So it's for you, and also your net cash flow, they will give you. So let's look at some solutions, or some questions. Let's look this. Okay, let's continue. It said a positive, looking at this amount, a positive net present value indicate that this project earns more than 12% on the investment. So looking at this, we definitely need to accept it because it earns more than 12% of the investment. So this is the other method, the how do you call it? The annuity, MPV of an annuity factor. So assumption 8 years, 12% rate, interest rate. Amount to be invested 16,000. This amount, the annuity factor, I'll tell you how to get it simple, easily. You know, we did what? 8 years. 8 years. 8 years. So you go for 12% of 8 years. You go to the table. So you calculate everything. You add all together for the past 8 years. That's what you get. So for example, you add all these. It's going to give you this amount, 4.9676. Does that make sense? One of you, okay, let me give you guys this. One of you should do it. Add this. Add all this. One of you should add it and tell me the amount you get. think there's a chat. She said 4.967. Okay, any other person? She said the answer is 4.9676. So let's go and check if that's correct. 4.9676. That's correct. So it's simple. That's the present value of an annuity factor. Shira too said same thing.
You have missed your career.
Hmm?
You should be in your finance.
I'm enjoying it.
How can you go back from finance? At least you have your old company
Mm.
and you're doing finance into it.
God create people and the career.
I'm sorry, I have to mute that person. So let's continue. Do you guys have any questions to ask? Do you have any questions to ask? So before I move to the next. I think there's no question to ask. I'll just move on. Okay. So this is the internal rate of return, the IRR. So the internal rate internal rate of return, in calculating it, first of all, you need to look for the present value of the cash inflow, which will equals to the present value of the cash outflow. And the net present value equals 0. So the internal rate of return, which is the IRR method, project with even annual cash flow. Let me show you this. Here, we've got the project project life of 3 years. Initial cost of what? $12,000. Annual net cash flow, which equals to $5,000. Determine the IRR for this project. First, you need to do or compute the present factor. Second, you need to using the present value of annuity table. So yeah, it's very simple. What you need to do is you take your 12,000 initial cost, divide by your annual net cash flow. If you divide it, it will give you what? 2.4 years. So looking at this project, within 2.5 years, you get your money back. You don't need to wait, for long. Does that make sense, guys? Hello, guys. Okay, I think there are 2 messages. Let me look at them. Yes, yes, yes. So we continue. So now the next thing is what? Using the present value of annuity table. Remember the table. Using the table, this is for 10%, 12%, 14%. So first of all, we've already calculated this, which is the 12,000 divided by 5,000 equals to 2.4. Using present value of annuity table, you need to locate the row whose number equal to the period in the project life. So let's go back to this again. How many years was it? Is it 12 years, 10 years, and so? So if you look into it using the annuity table, let's say for 10 years, you remember how we used the annuity table? We had this plus this. Let me show you guys. Let me go back. 10 years. 1, 2. If you add these two, add them, you need to get to 2.4 because that's what it shows. So in getting the 2.4, if you look very well in year 3, we've got 2.48, but we've got 2.400. So the closest is what? 2.40183 or 2.3, but the closest is this 12 years. So we'll go with this year 3 and the 12 years. Does that make sense, guys? Well, I'm not getting any message. Okay, there's a message here. Repeat, please, Amani. Okay. Okay, Amani. Do you know how we did? Amani, do you know how we got the annuity for this one?
Yeah.
For this one. So,
yeah.
So let's look for between 10 to 12. Let's calculate year 1, year 2. I'll need to, let me increase the. Can you see it clearly?
Yeah, I can say it.
So calculate it, add this and this, which one you get up to. First of all, do for 10 years, year 1 and year 2 and year 3, or year 1 and year 2. If you get up to 2.4 something, let me know.
For 10%, you mean, not years, right? For 10%. Looking at 10%, right?
Do for 10% and let's see.
Okay.
Do for year 1, year 2, year 3. And let's see. Do for 3 years. Do for year 10, 11, 12. Are you still calculating or you're through?
1 minute for the 12%.
Okay. Okay, there is a message here. Thanks, Fro. I will take leave of you. I enjoy the lesson as it brings my finance background back. Best wishes. Thank you too. Thank you. Don Amani. So let us know.
Okay, so for 10%, it's 2.4868. For 11%, it's 2.4786, and for 12%, it's 2.4019.
So which do you think is more closer to 2.400?
12%.
12%. So we'll go with the 12%.
Yeah.
Okay. Okay, we'll go with the 12%. So let's look at what we have there. I have to reduce this. That's it, 12%, 2.400. You could say it. It's not magic. So does that make sense? At least most of you now understand how to calculate that. You could say it is simple, easy to do. So let's look at it. The IRR is the interest rate of the column in which the present value factor is found. So look at the present value factor. We've got the 12%, 3 years. The IRR is approximately 12%. So let's look at most of the strength weakness and limitation of all the method we've been talking about or we've been calculating since. Payback period, basis for measurement, they use what? They use cash. And the measure expressed as number of years, that's what they're after. The strength, which is the advantage, is easy to understand and it allows for you to compare across projects. Limitation, it does not consider time value of money. And what it doesn't consider cash flow after payback period. While the accounting rate of return, the basis of measurement is what? Accrued income. Measures expressed as the percent. Strength, how many strength does it have? It has up to 2. It's easy to understand, just like payback period. It allows comparison across projects, same as payback period. Disadvantage, it doesn't consider the time value of money, same as payback period. And it doesn't give annual rate over the life of a project. The net present value, the basis of measurement, cash flow, profitability. Measures are expressed in, for example, the amount like the dollar or pound or something like that. The strength, it considers time value of money. And also it accommodates different risk level over a project life. And the limitation is difficult to compare this. You got to compare some project. Internal rate of return, the basis of measurement is what? Cash flow, profitability. The measure expressed as percentage. The strength, it considers time value of what? Of money, and it also allow comparison of some project. But one limitation is that it does not reflect varying risk level over the project life. Like the risks, it doesn't reflect that about the project. So thank you guys. Do you have any questions to ask?